Welcome to AHA Math and Science. In today's video, we'd like to discuss how small and larger caps kind of perform during recession. So in the last few days, you can see that actually the stock market really kind of rallied strongly. In fact, the SP 500 just kind of overtook the February 2023 high. So now it's kind of had the highest close since August of 2022. And at the same time, in the last few days, actually the last 2000, which is for the small caps, you can also see actually it kind of rebounded strongly, but clearly it's still kind of far away from the February 2023 high. But it seems that in the last few days, actually the last 2000 kind of outperformed the SP 500 a little bit. So we want to actually ask this question: how do these small and large caps kind of perform during recession? Given that a lot of people are kind of predicting that a recession may be coming, it's almost kind of inevitable. This which was also kind of discussed in a number of videos in this channel. So in the weekly summary for the past week, we discussed this ratio of the last 2000 versus the SP 500. So when this ratio goes down, it means the last 2000 or the small caps are kind of underperforming the SP 500 or the larger caps. So when the ratio goes up, it means like the last 2000 is outperforming the SP 500, or the small caps are doing better than the larger caps. So in a way that this ratio is also kind of indicating how the economy is doing. If the ratio is not, it's going down, it usually kind of signifies the economy could be kind of seeing some weakness. And we point out that for the current bear market, you can see these two legs of drop for this ratio, and then which is kind of similar to what we saw in the previous two bear markets, once during the 2008 great financial crisis, where you actually see the two legs drop. And then another case is a burst of Dotcom bubble, which is also two legs of drop. And then we point out that usually after these two legs of drop, you see the kind of a spike of the this ratio, indicating the small caps kind of outperform the larger caps very rapidly in a very fast way. And then after some time, the bear market may be over. In the case of the Dotcom bubble, it ended in October 2002. And in the case of great financial crisis, the bear market actually ended at here in March 2009. And we asked the question that could something similar happen in the current cycle, where you see the outperformance of small caps first very strongly, and then maybe the bear market will be over. In today's video, we're going to basically look at this chart, but from a slightly different angles. And let's see if we can actually get some more information from this plot. So you look at this actually chart, and we noticed actually just in the past few days, it's already kind of start this ratio starting to turn around and it start kind of increase, kind of inching upward. And this low here is actually a little higher than the low that this ratio made during the pandemic, which is in March 2020. So we kind of already see this uptrend that's kind of start to be formed. And we noticed that a similar kind of upward trend also formed during the previous two bear markets, which is at here. You can see that it started to make a low, but it did not really make a new lower low. It just started to make a high low. And similar thing happened during the bear market induced by the burst of Dotcom bubble. And so this is very clear that it looks like these two things could be really kind of comparable. And we also want to point out, actually, interesting enough, the coincidence of the recession with this peak and the rebound of the small caps. And for the 2008 great financial crisis, the recession started from December 2007 and ended in June of 2009. And you can see that during the recession period, the small caps were indeed actually starting to outperform the large caps. This thing is already kind of in the upper trend. A similar thing happened, and during the 2000 bear market, that's the recession period, which is from March of 2001 to November of 2001. In fact, the small caps rebounded much earlier than the recession actually started. So almost like 2 years early, the small cap stock already rebounded. And you can see that it's really kind of interesting that if in our case, if a recession is on the way, maybe late this year, based on a lot of the economic indicators, and we could actually really comparing a case like, like this one, where you can see that you have a spike, which is a strong rally of small caps, which we also added here, and then maybe followed by recession. We could also see a recession here, as a lot of kind of economic indicator already point to that. And the fact that during a recession, the small caps can actually rally strongly, even stronger than the large caps, is something we really need to keep in mind. That that recession does not necessarily mean that actually the stock market is going to be in weakness, and sometimes it could be actually on the contrary, that the stock market rally strongly and during the recession, but obviously eventually maybe all the gains will kind of again go back to a kind of a decline. So, but at least from these two data points, you can see that during recession, you could have actually see the small caps start kind of outperform the large caps. So these are very kind of strong lessons for us to keep in mind. But we also want to point out that we do see cases that during recession, the small caps continue to kind of deteriorate and then underperform the large caps. That happened during the early 90s. But this is a recession, but actually this recession did not cause a bear market. So there's a difference between this one and the one we are currently in. And then this is another example. The recession started in February of 2020 and ended in April of 2020. So this is like a very sort of a short recession, and basically, it's only like 2 months. So and also it's a very special case. So I don't know how much we can make out of this case, but just for completing of this discussion, we want to also point this out. So now we already kind of start to discuss that actually the similarity of the current scenario to the burst of dot-com bubble. Let's also look at actually the charts. For the present time, you can see that actually this whole cycle you may kind of start to see from actually the early 2020. After the pandemic, you can see the large caps actually rebounded very strongly. By September of 2020, the larger caps already made a new high, yet the small caps have not. But then very quickly, you can see the small caps start to catch up very, very strongly. So the small caps start to outperform the larger caps. And then kind of the small caps start to go sideways, where the larger caps continue to make a high. And that's when actually the market peaked. That's where the start of the bear market. And so this is the initial phase of drop. And after that, you can see in the past almost like 9-10 months, the indices are kind of in this sideways zone. Obviously, the large caps are outperforming the small caps because the small caps are still far away from the February high, but the large caps already just kind of overtook it. So if history is any guide, if we are already kind of in this period of when the small caps start to kind of outperform the large caps, we would expect at least the small caps will all kind of at least kind of get to the February 2023 high. So this is something to keep in mind. And then when we start to kind of compare the present time versus actually what happened in the late 90s and then early 2000, we see a very strong similarity. You can see before the big bear market, in late 1998, the small caps was already in a bear market, and the S&P 500 had a correction of more than 15%. But after that, the larger caps was able to rebound very quickly, but the small caps was already showing weakness. After some time, you can see the small caps start to kind of catch up, and then so basically during this time period, which is really kind of like right before actually the bear market starts, and that small caps start to kind of outperform the larger caps a lot. And then after that, small caps showing weakness, and then the S&P 500 is kind of going sideways. So small caps outperform the large caps is really kind of a signature that we need to be alert, which is could be indicating the sort of like a more precipitous drop ahead. And this is the initial phase of drop. But then we see this whole period for most of like 2001, you can see the small caps start to kind of outperform the larger caps. Large caps are kind of dropping, declining, but the small caps, and this is during, I think, September 11, 2001, where the market dropped precipitously. But you can see like overall, the market was kind of in the uptrend for the small caps. Well, the large caps more like on a declining sort of path. So there's a clear evidence of the small caps outperforming the large caps. And this is actually indeed for a period where the economy was in recession for most of 2001. That's when the recession occurred. So, and it's really kind of speaks strongly that, you know, when economy is in recession, the market could actually rally strongly. And this is something we want to keep in mind so that we'll be prepared, you know, when bad things happen. But then, you know, just keep in mind that sometimes, you know, the stock market and the economy kind of like disconnected. And then after that, you can see that's where actually the final leg of drop happens, where the corporation earnings deteriorate, everybody realizes that, and then the stock market just kind of dropped precipitously. So given this sort of, you know, this lesson we learned here, and we always see a lot of similarity for the past few years, how these actually comparison of the small caps versus the large caps kind of perform. And we could be really kind of doing this phase when the small caps going to rebound very strongly, and then the large caps maybe rebound a little bit. So the target may be like, you know, looking around like the August in 2022 high, where the last of 2000, the small caps could be also kind of approaching that level. And you will see a clear evidence of outperformance small caps by large caps. If this do happen, then we need to be alert that possibly this is really going to be kind of signifying that the final leg of the drop is not a far away, where everybody suddenly realize during this recession period when the market actually rallied, but the corporation fundamentals already kind of deteriorate. And after rally is over, people start to realize that the earnings are really kind of go bad. And that's when we perhaps kind of see the final leg of drop. So this is a lot of information, and I hope that you know, this information give you some thinking and help you to actually, you know, make some good trading decisions. And but again, you know, technical analysis is never kind of 100%, you know, reliable. And so in any case, you know, we have to be kind of be alert and always kind of put kind of risk management on the top, you know, so that you know, we will be always kind of considering many different possibilities when actually trading stocks. So I hope you have enjoyed this video and found the information presented in this video interesting. Your support really means a lot to this channel, so I can have the motivation to make more videos like this one. So please do not forget to click the like button and also to subscribe to our channel. And thank you for watching.